Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Dr. Ellman, founder of the Blue Collar Investor, to discuss how we can use the Nasdaq-100 Volatility Index, or VOLQ, in covered call writing decisions. Dr. Ellman, it's been a while since you've been on the show. Welcome back to Trade Talks. And before we get into the strategy, let's cover the basics, starting with an overview of why you would use QQQ in this type of strategy. And what VOLQ is.
Well, QQQ is an exchange-traded fund that consists of 100 of the largest domestic and international non-financial companies that trade or are listed on the Nasdaq exchange. So we're talking about companies like Apple, Google, Facebook, Microsoft, Amazon, the big boys. And what makes this so applicable to covered call writing is that it's a highly liquid security, as are the options associated with QQQ. That means we're going to have very favorable price executions with our trades. In addition to that, since we're dealing with large cap tech companies, the implied volatility inherent in the security will allow us to generate significant option returns and annualized returns, even when we're promoting a defensive low risk strategy like I'm going to be describing in this particular discussion. Now, VOLQ is the Nasdaq-100 Implied Volatility Index. So what that does and why it's such a great tool to have for covered call writing, it will give us the implied volatility of the Nasdaq-100 stocks over the next 30 days. Now, the actual stat is expressed in an annualized basis and on one standard deviation. So to create a 30-day implied volatility, we have to divide the VOLQ by 3.46, which is the square root of 12, since there are 12 30-day time frames in 1 year. And that will give us the implied volatility for the Nasdaq-100 or the Qs over the next 30 days.
What is the covered call writing strategy?
Covered call writing is a low-risk option selling strategy. So I'm underlying the word selling because that implies we're going to be generating cash into our account for undertaking the contract obligation. So if I could describe it, let's break down the three words in the term covered call writing. Covered means that we buy the stock first. So we are covered or protected. We know our cost basis. Now, once we own the shares, the second word, call, describes the type of option that we're selling. So when we're doing covered call writing, here's how it works. We are selling some unknown person the right, but not the obligation, to buy our shares from us at a price that we determine, that's called the strike price, by a date that we determine, that's called the expiration date. Now, I do monthly options, and most expire on the third Friday of the calendar month, 4 p.m. Eastern Time. In return for undertaking this contract obligation, we are paid a cash premium, and that's what covered call writing is all about. Now, Jill, the third term, writing, that means we are initiating a sell to open order, and that's what we put on our brokerage form. We are selling to open the call option to establish a covered call trade.
What strategy are you proposing, and walk us through a real life trade using this type of strategy?
Well, the strategy I'm proposing and what I've created here is a low risk, high probability strategy that will generate a significant annualized return. My goal is 10 to 15% annualized a year. And Jill, in this low interest rate environment, that can be quite enticing to a lot of investors. So basically, there's 4 steps to this procedure. Step 1, at any point in time, look up the price of the Qs. That's easy. Step 2, look up the listing for VOLQ. Now, once we have that, we have to divide it by the factor I alluded to before, 3.46. That will then give us our 30-day implied volatility, how much higher or lower the Qs can go over the next 30 days. We focus like a laser on the low end of that range. That is our goal for our break even. Step 3, we take a look at an options chain and see which strike price, it's going to be in the money or lower than current market value, will generate that amount of premium that will bring us from current market value over here down to the low end of the trading range as established by VOLQ. Now, step 4 is to make sure that that premium has a time value component to it. That's our profit. Let me give you a quick example, Jill. Let's say hypothetically we buy a stock at $100 and we sell the $70 call option for $30. Now let's take a look. We bought the stock at 100, we agree to sell it at 70, minus 30. We get $30 from the call premium. Where are we? We're no place. We haven't made any money. And this strategy is all about generating income. So that premium that's going to bring us down to the break even has to also have a time value component. In this hypothetical, it has to be higher than $30. So everything above $30 is called time value. That's our profit. The $30 itself, the amount the strike is lower than current market value, is called intrinsic value. Now, I've back tested this strategy with the Qs, and it works. The implied volatility of the Qs will allow us to accomplish both of these parameters, bring us down to the break even as established by VOLQ, and also have a time value component that will allow us to generate a significant annualized return.
So, Dr. Ellman, how would you set this trade up for the November expiration?
Well, Jill, I actually wrote an article for Nasdaq.com on October 22nd. And at that point in time, the Qs were trading at 284.32. So that's step 1, look up the price of the Qs. Step 2, what is the VOLQ stat? Well, it was 32.16. Now remember, we have to divide that by the factor 3.46 to get the actual 30-day volatility, implied volatility, which came to 9.29%. So now we can establish a trading range based on VOLQ of the Qs at that point in time. So our target for our premium, 9.29% of 284.32, came to 26.69. That's our target premium that we're looking to generate when we sell that call option that will bring us down to the low end of the range. That would bring us down to a break-even point of 257.63. Okay, step 3, we went to look at the option chain. What call option in the money, lower than current market value, is going to generate that target premium of 26.69? Well, actually, we found the 261 strike generated a call premium bid price of 26.47, which did align with our goal of 26.69. That would bring us down to a break-even price of 257.85, which aligned pretty close with our 257.63. That was step 3. Now, step 4 is to make sure that that premium had a time value component to it. Otherwise, why are we bothering? So we took our actual 26.47 and we broke it down into intrinsic value and time value. Well, the intrinsic value is the amount that the 261 strike is lower than current market value of 284.32. We come to 23.32. We deduct that from the actual premium we received, 26.47, and that gives us an actual time value profit of $3.15 a share. And if we use the intrinsic value to buy down our cost basis from 284.32 down to the strike of 261, that comes out to a 1.2% 1-month return, annualizes out to 14.4%. Now, since this is based on one standard deviation, it's a high probability trade. The amount of protection we have of that 1.2% profit is 8.2%. That means the Qs can drop 8.2%, no more, and we still will have generated that 1.2%, 14.4% annualized return.
All right, and to wrap up here, why is VOLQ useful for a covered call strategy in the Qs?
Well, in my view, VOLQ is amazingly useful because what it does is the implied volatility stat that we generate will allow us to establish a low end of the expected trading range 68% of the time. So it's a high probability trade. That will then guide us to a specific strike price that we're going to use when covered call writing the Qs. And so what we're doing here is we're using 4 steps to create a low risk, high probability trade that's going to generate a significant annualized return. Now, Jill, if I could just say one final thing. We talked today about covered call writing, the Qs, incorporating VOLQ into our decisions. You can absolutely use this strategy for selling puts as well. And in my opinion, you can also use it when you're doing covered call writing with the securities within the Nasdaq-100 stocks. So it has a much broader application than just covered call writing the Qs.
All right, Dr. Ellman, thanks so much for joining us on Trade Talks.
Pleasure.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.